Hi everyone, so today we're going to go through paper 6 of the Advanced Tax module by ACCA, and this would follow the Income Tax Act in Singapore. So the paper is December 2018 and you can download it from its website. So basically I'm going through the first question, and that concerns foreign tax agreements, double taxation agreements, foreign tax credits, differences between tax residents and non-tax residents in Singapore and how that income is treated, as well as the benefits for incorporating a subsidiary versus a branch. So let's move on to the question. So this question is basically a question about tax advice to this investor, Mr. Umar Pollard, and we would take a look at the scenario first before looking through the questions. Okay, so as we go through this excerpt, let's pick out some relevant information which we feel that might be useful to us later when we're sort of tackling the questions. So it also allows you to recall some of the information that you learned pertaining to double taxation agreements and the treatment of foreign source income in Singapore, and basically how inbound investment is treated in Singapore. Okay, so Mr. Umar Pollard, a citizen of country U, lives in and is treated as a tax resident of country U. He owns 100% of UCL, a company incorporated and tax resident in country U. UCL carries on a profitable business in trading a diversified range of consumable products for infants and children. So this is a Section 10(1)(a) trade. He wants to expand his business interests into Asia, and he wishes to use Singapore as a launch pad from which to establish his presence in the region. So he was presented with 3 profitable companies, A, B, and C, with similar businesses as UCL located in country A, B, and C respectively. So similar businesses. Why is this important? If you recall, CA, capital allowances, same trade is an important test that we need to fulfill in order to carry forward capital allowances. So maybe that's something that might be useful. It is proposed to acquire 45% stake in Company A, 30% in Company B, 15% in Company C. HGR, okay, headline tax rates, country A is 30%, country B is 20%, and finally country C is 10%. So why are these rates important? Remember, for FSIE, foreign source income exemption, headline tax rate needs to be at 15%. So straight away we know company C does not qualify, right? Does not fulfill that condition. Mr. Umar proposes to set up a new company entity to establish a permanent legal presence in Singapore as a base to make his acquisitions. So he's unsure whether to set up a branch or subsidiary company of UCL. So these two entities have a different tax implication. Although initially this new entity will only be a holding structure, so investment holding for 3 investments, it's possible that some trading activities may be added in the future. So holding structure means there's no Section 10(1)(a), but if trading activities are added, then there will be Section 10(1)(a). Whichever entity structure is chosen, funding for the Singapore operations will be provided through equity or debt. So that's going to trigger a thin cap rules, or in Singapore there's no thin cap rules, but sort of trigger how our profits going to be extracted from Singapore. So being a conservative businessman, he was start small, only acquiring a small office with 2 key staff. for the purpose of Singapore operations. So this could be potentially maybe some individual tax advice, depending on the period, or it can be what kind of incentives does Mr. Umar qualify for? So like M&A allowance, right? Through his own research, he discovered that many tax incentives, okay, so he would like to, interested in qualifying for these incentives to yield the maximum after-tax profit. Singapore has not concluded a comprehensive tax treaty with any of the A, B, C, or EU countries. Okay, this is going to be important as well, right? So we're going to see how can you remit profits to Singapore at a tax-efficient manner, and how can you remit profits out of Singapore to country EU in tax-efficient manner, or whether is it necessary, right? Okay, let's move on to the next slide. So I've made a summary of this information here. So country A, which is company A, B, and C, 30, 20, and 10 tax rate. So this is something maybe that we want to take note of. And then for M&A allowance, maybe you want to also take note of above 20%. This one. Okay. So the question here is, as a tax advisor to Mr. Umar Pollard, write a letter to him advising on the following matters: the similarities and differences in tax treatment of a subsidiary company and a branch in Singapore. Why, based on the proposed activities, will be better for him to use a subsidiary company structure. Okay, so important to note: 1, similarities; 2, differences; 3. So this question, they didn't ask you to decide which one is better. They gave it to you. Okay? They decided that a subsidiary is better. So prove why a subsidiary is better, which means list the benefits of a subsidiary which a branch is not entitled to, which in the case of Mr. Pollard's investment, it would be more appealing to him to set up a subsidiary. So let's go through the similarities first. Okay, so as long as you make profits in Singapore, you are subjected to the corporate tax rate of 17%, and this is for Section 10(1)A income. So a subsidiary can conduct Section 10(1)A income, so can a branch. And both are eligible for corporate income tax rebate of 20% at 10K cap, okay, for YA 2019. So this is the cap. Okay, so the rebate cannot exceed 10K. You are also eligible for partial tax exemption for the first 300,000 on chargeable income. If you want to get the specific rates, always look at the back of your sheet, because that's where they will give all the specific rates. Not eligible for startup exemption tax on chargeable income if it is a wholly owned subsidiary or branch which is a non-resident in Singapore. So this is a similarity as well, because in order for you to qualify for SUTE as a subsidiary, there are certain conditions which you need to fulfill. So if you are a wholly owned subsidiary, so which means 100% of the subsidiary is owned by a foreign HQ, then you will not qualify for SUTE. You need to be at less than 20 individuals, or if there is a company as a shareholder, an individual needs to hold at least 10%. Let's go on to the differences. Subsidiary is a separate legal entity from the overseas foreign establishment. Okay. A subsidiary can be a Singapore tax resident if it conducts board meetings in Singapore. So how do we determine if an entity is Singapore tax resident? It must conduct board meetings in Singapore, which means management and control is in Singapore. Therefore, that company is a tax resident. It does not necessarily need to fulfill a certain revenue threshold or it needs to conduct all its business here. Whether board meetings, which is indication of management controls in Singapore, that is sufficient. So a branch is ordinarily regarded as a tax resident in a foreign country where the head office is located. So it's seen as an offshoot, okay, of the foreign country. Subsidiary can enjoy benefits of a tax treaty. Why? Because in order to enjoy benefits of a tax treaty, you need to be tax resident. So if a branch cannot be a tax resident, it will logically follow that it cannot be a tax treaty, cannot enjoy benefits of a tax treaty. Also, subsidiary, you can enjoy FSIE under Section 13(6). You can also claim foreign tax credit, and for benefits of a subsidiary, we're just going to go into the foreign source income exemption. So state what is likely to occur if you were to have a subsidiary in Singapore. If you were to have a subsidiary in Singapore, right, all the countries, let me see. All the countries will start to remit dividends to Singapore, right? So you have country A, you have country B, you have country C. And then this is your holding company. So because this income is remitted to Singapore, we can tax it. And what do we tax it at? In Singapore, we tax it at 17%. However, our Income Tax Act provides that if these dividends are foreign sourced, right, then they are eligible for income tax exemption. But what must they fulfill in order to be qualify for this exemption? Firstly, you must be subject to tax in the foreign jurisdiction. So in this case, so let's look at what is the actual scenario. A, B, and C, they actually suffer tax, correct? So I think it was at different rates, but they still suffered tax. So this scenario, all of them qualify. Okay, headline tax rate is at least 15%. Now, A qualifies, B qualifies, C does not qualify because C is at 10%. So, you need to inform Mr. Umar that if he were to set up a subsidiary in Singapore, he can remit dividends from A and B, and he can enjoy the foreign source income tax exemption. However, if you were to remit dividends from C, he would have to pay tax at 17%. Finally, whether the remittance of these dividends is beneficial to Singapore entity. So these are